Good morning, everyone. I'm Tom Jessop with Fidelity Digital Assets. It's my pleasure to be here with Ann Richards, the CEO of Fidelity International. Before we get started, a little bit about Fidelity International, a little bit about Ann. So Fidelity International offers investment and retirement solutions to over 2.5 million customers in 25 countries with close to $800 billion in total assets. Its clients range from central banks and sovereign wealth funds to wealth managers and private individuals. Ann joined Fidelity International in December 2018 from M&G Investments, where she was CEO and a director of its parent company, Prudential PLC. Ann has almost 3 decades of experience as an analyst, portfolio manager, and CIO, and is a strong proponent of ESG investing. Thank you for being here, Ann.
It's a real pleasure. Thank you for having me.
So I think this could be one of the least crypto-focused panels at the conference, but I think it's important because we have an opportunity to talk to Ann about some of the broader trends in investment management and then talk a little bit about how blockchain technology and digital assets are starting to feed into that. So Ann, one of the things that we had seen from our institutional survey was that a large percentage of clients globally said that the pandemic was a catalyst for them to start thinking about the space, largely driven by macro conditions. From your perspective and from more of a broader investment management standpoint, how have you had to rethink the business? What's changed in the broader business as a result of the pandemic?
Well, the sort of really obvious thing that I'm sure most of you in the room will have been through is we had to flip the entire business in every region in the world pretty much virtually within a very short space of time. And I think what that reinforced for us as a business is how important the digital world was to us being able to do anything that we do. So if you like, I think even in some of the more conservative parts of our industry, that flip to digital sort of changed the environment in which we were all thinking. I think more broadly than that, the macro environment, which you touched on and which the previous panel also touched on, we went into a totally unprecedented macro environment given the extremes of QE, the extremes of intervention that we saw from central banks around the world, which has taken us into a completely new economic framework that is causing asset allocators to have to really figure out scenarios and figure out what it is they are trying to do across, for example, an institutional portfolio in a totally different way. It feels that we have less of a macro framework to help guide asset allocation decisions. I wondered if you were going to give me a new mic. It didn't feel like this one was working. Is that better? Yeah, great. So I don't know if you heard any of that, but that sort of broader macro environment as a consequence of central bank action, which, by the way, I know not everybody in this room is a great fan of central banks. They've done a pretty good job of keeping the show on the road. I've got to say that. But it means that from an asset allocation perspective, we are looking at a new paradigm, and that's an overused phrase, but I think in this instance it really is true. And you can see that in the wrestling match that's going on within central bank centrals in terms of figuring out how we all respond to inflation. So how they respond to inflation. So when you then think from the perspective of an institutional investor, what you're trying to do if you're looking across that asset allocation piece is figure out how you get that balance between diversification of returns, increasing your risk-adjusted returns, figuring out how you still get income out of it, because most asset allocators do have some kind of income requirement. How do you do that asset allocation, that asset liability matching in a world where you don't really understand what the levers are on macroeconomic policy? And so that really takes us into a space, I think, of opening up minds, this combination of that move to digital in the working environment and that new macroeconomic paradigm into thinking, well, maybe digital assets have a bigger role to play in our overall asset allocation. And I think that's what's really changed in the last year or so.
Yeah, I mean, it's interesting. I think I may need that as well.
Oh, sorry.
It's okay. Can folks hear me? So just like following on the digitization trend, so obviously there's been some amazing things happening. I mean, clearly European fintechs have been at the forefront with things like neobanking and bringing more digital experiences to investors. At the same time, we have a whole class of investors who have been spending a lot of time in front of computer screens in their homes. So how do you see digitization playing out broadly in the space? There's obviously the retail component, but as it relates to institutional investors, what are some of the things that Fidelity International is focused on, whether it's service provision or streamlining, certain client experiences? How has that changed?
This feels really cool, passing the microphone back and forth. So there's a couple of different things. You're seeing, I think, in the workforce now, the majority of our workforce are pretty close to being digital natives. And the conversation on the metaverse that was just going on there. I mean, when you think about what I do in terms of client service to those 2.5 million clients, I mean, and I think back to the early .com era when we were, first of all, looking at MySpace and stuff like that, and actually thinking about this metaverse, but we didn't really have the technology to make it a really great experience. Now we have. So if you think about our provision of services into that, thinking and reframing the context for that from a service point of view, I think is really important. But I think there are other things which the whole move to digitization opens up for us. First is about the back end. So it's not about the user experience at the front end, but it's about the user experience in terms of delivering stuff much more cleanly. Financial services system is a really ugly mishmash of lots of interconnected bits, some of which sit in basements written in Fortran or COBOL even, and it's just horrible, horrible, horrible stuff. When you move to a distributed ledger type of world, for example, you can start to imagine those really complex supply chains being made much more seamless, being much closer to instantaneous, which takes away some of the clunkiness that if any of you interact with the regular financial system, you will be all too aware of with your bank or with your brokerage. Some of it's really, really clunky. So I think that if you think about the front end and the metaverse and where that might take us to, if you think about DLT and the back end, but then you also start to think about how, for example, the tokenization of illiquid assets. Could you take a bridge? Could you take an airport? Can you take a really illiquid asset and tokenize it in a way that democratizes it and makes it much easier for people to build a personal portfolio, or for an institutional investor to build an institutional portfolio that has a really targeted by geography, by asset class, by asset type portfolio? The tokenization within that is really, really powerful. So there's a whole bunch of different things that are going on here, and it's just a question of how you move forward within a regulatory environment quite often, which is not yet caught up with the pace of change of what is going on across all of these different areas.
Great. Let me see. Oh, it's working now. Okay. So just picking up on that, so obviously there's a couple of, sorry?
Oh, are you okay with that?
I'm good, yep. So just in terms of a couple of these trends that are, so we've got, kind of in some cases, a low return environment, folks rethinking an asset allocation, discussion about is the 60-40 approach dead, and then you have this new technology. You have DeFi. You see the yields that are being generated in the cryptoverse, and also the price appreciation opportunity. And all of these things are coming together very nicely in terms of rethinking financial services for the future. We see that with our clients, and I'm sure your clients, institutions increasingly are more interested in the space. But from a European perspective, what are still the challenges, particularly with some of the more traditional investors, the pensions and endowments, in thinking about making an allocation to the space? Is it regulation? Is it lack of understanding of the technology? What is it, and if so, how can we address that as an industry?
Yeah, good question. I mean, it's clear that regulators around the world are taking a somewhat different approach on this, and so and that is an impediment to the more conservative institutional investors, no doubt about it, because the last thing you want to do is to put somebody's pension into an asset that the regulator then tells you you've done something bad in doing it. So there's an inevitable caution about that. Regulators have a tendency to lag. We all know that. So I think that is an impediment. Having said that, I don't think all institutions feel that means that they can't do anything. So I think you have to distinguish institution by institution and indeed market by market in that. I think specifically on crypto as opposed to digital assets more generally, I think the volatility is something that remains something of a challenge, because the 60-40 portfolio that you mentioned, it has been a challenge for many asset allocators that correlations have gone up over time, and it doesn't provide the same diversification benefits that historically it did between a simple mix of equities and bonds. Now, crypto assets bring a very different dynamic into that, so they behave differently to conventional assets, Whether that remains true over time, if they become more and more owned by the same investors, is an interesting point. But for now, they certainly bring something different, which is good on the one hand, because you get that diversification effect. But if you also introduce a massive amount of volatility in the portfolio, again, from the perspective of somebody who has a fiduciary responsibility, that might feel reckless. So I think we need to become truly institutionally credible. We need really good hedging instruments that give some elements of the upside, the return profile, but take away some of that extreme volatility, which is, I think, a bit of an impediment to this. So I think that's one important part. And I think an evolution of the regulatory environment is another. We don't need them to regulate everything. We probably don't want them to regulate everything. But to allow them to regulate enough so that the more cautious institutional investor can get involved, I think is quite important.
Got it. And, I think maybe coming closer to home, if you think about institutions and sort of two practical applications of blockchain technology which don't necessarily touch upon crypto per se. One, you mentioned tokenization. The other one that an increasing number of institutions are focused on is the prospect of a central bank digital currency or some form of stablecoin regulation that would bring that into sort of mainstream finance. Can you talk about both of those topics and a little bit about how you see that playing out and where the opportunities might be?
Yeah, it's really interesting. And I think when we have the digital bank central currency, that's when digital assets will truly go mainstream in the institutional space, because that will somehow feel blessed and safer. Which, again, to that point about limiting individual fiduciary downside risk, I think that is important for a proportion of the institutional base. I've got to say that the majority of the large institutions are definitely looking in this space. We know that from your survey. Stablecoin is interesting because when I look at the characteristics of stablecoin in isolation, they don't look very dramatically different, actually, to a money market fund, to a backed money market fund. So I question whether that is really something that in the very long term has real longevity if digital central bank currencies become a thing. But that's a discussion point. I don't know that, but I think that's quite interesting. I think crypto is quite different to that, actually. Digital central bank currencies, I think we will have one within the next 5 years. We'll probably, of a kind of developed market, serious digital central bank currency. I think that will absolutely become a thing and become more of a thing. I think as individuals, we need to be really thoughtful about what the implications of that are, because on the one side, huge potential opportunities come out of that. So, that machine-to-machine automation that becomes possible with the digital central bank currency. One of the things that we talk about is the smart charging of electric vehicles, that you just don't even need to remember when to switch on, switch off. It can all just happen in the background. Programmable money is a really profound change that might make all sorts of things dramatically more frictionless than they are today. On the other hand, there are some real challenges about what that means for how much personal freedom, how much personal information actually potentially are you giving up to the provider of that central currency. It's great to have programmable money if it stops you having the third drink when you choose to, or having a cigarette if they don't want you to spend your benefit on it. These are quite profound personal restrictions potentially that we, I think, have to think through, and it really is important that we have a very honest conversation about the implications for that. There's a final one. This is maybe a bit nerdy, but from my perspective, if we move down the track with central bank currencies, whereby you have your own personal wallet with the central bank effectively on the central bank balance sheets, which is one of the models that's being considered, if you move down that track, you start to then say, well, what is your bank for? Because you're no longer depositing money with the bank. Why that matters potentially is that the banks then require effectively to rely on wholesale funding, which is possible. There are some banks do that already. It's not necessarily an impossibility, but it does weaken the transmission mechanisms that currently we use the banks as multipliers, so that when you make an interest rate change over here, the way that feeds through to the real economy is multiplied. So I think in terms of how monetary policy is fed through to the real economy, potentially that changes quite dramatically. So if we're really think, in the mode of thinking that this move to central bank digital currencies is something that has got to happen. We really need to make sure that we do understand what are the both intended and unintended consequences of that, because they are quite profound for all of us as individuals as well as for the economy as a whole.
Yeah. So picking up on that sort of adoption question, I want to come back to the application of this technology in traditional finance, because one of the interesting things about public networks is that you see this viral adoption and this growth and this just raw creativity. And when you talk about traditional finance, it's what I think about as it's a non-viral network effect business. You need a cadre of asset managers, brokers, and others to agree to some new market structure or some new technology implementation. And I'm, coming back to tokenization. How do you think that plays out? I mean, I think the critique might be that there are a lot of point solutions and there are examples of deals that have been done. But do you have any perspective on how the industry can get around the technology?
It's really fascinating because I actually view the evolution of the financial system, if you think what we have today, is one of the great viral innovations. Because if you think about it, when it started from this city-states going back, as was mentioned earlier, 400 or 500 years, and it sort of gradually sort of grew from that, and all of the innovation that came, whether the creation of the joint stock company, there's even cash itself is a wonderful innovation. If you think about that history, the financial system has been pretty adaptive over quite a long period of time. And we might think of it as a little stale and with too many entrenched players. But even going back to electronic payment systems, which didn't really exist to the extent they do today 20 years ago, there's been massive innovation. And so we shouldn't ignore that it
can happen from within.
And it historically has happened from within.
Yep.
So I think that's just an important sort of point to lay down there. But there is unquestionably, with some of the stuff that I talked about earlier, when you look at that, the complexity of that operational supply chain, there are players with a lot of vested interest. And I remember, actually, it was John Cryan when he was running Deutsche Bank a few years ago, and I was talking to him, and so this must be 5, 6 at least years ago, and I was talking to him about distributed ledger technology. Because when I look at a lot of my business, a distributed ledger makes simultaneous and instantaneous some of the chains that at the moment are entirely sequential. And that's what I think is most powerful about it. You get that simultaneous as opposed to sequential, effectively processing power. And he said, Anne, but the thing you've got to remember is that everybody makes their money at those points of friction. So I think that's the vested interest. But having said that, as the solutions become clearer and as the benefits become larger from that adoption, eventually the incumbents, the established players who are maybe, have a vested interest in not changing, do eventually change. We do see that across the industry. And so I think that will increasingly happen. I think it's just happening a little slower than maybe we thought it would.
Yeah. Just on a related industry theme. So one of the things that we've seen a significant sort of change of perspective on is the role of asset management products in this space. Year on year, respondents to our survey expressed a much stronger interest in investment product. I think for a host of reasons, it fits into in some cases, an existing regulatory structure. I think in other cases, just given how quickly the space is moving, there's a recognition that there are a lot of experts in the industry who are understanding these protocols and starting to develop new mechanisms for asset management. And I'd be curious to get your perspective running a large investment management firm. How do you view that space? What is the outlook for active management in this space? Will it be something that startups and other nimble players take on, or do you start seeing large asset managers getting into the space? And what are the catalysts to do that?
I think every innovation cycle in history pretty much has been started by the entrepreneurs, the startups, the great idea, which eventually its time comes, and then you see the adoption by larger companies of it. And that happens either through partnering, through what we do within our own business. We have, as you know, Tom, we have our strategic ventures team who are always on the lookout for really interesting companies doing really interesting things that we can get involved with by maybe taking a stake in them, but also by then contracting with them to explore what it is that they can bring to our business. And then you go all the way through to full acquisition by large companies and smaller companies to sort of pull that into the fold. And I think that ecosystem is incredibly vibrant and healthy just now. And not every idea we're showing is a good idea, that's for sure. But it's clear that there are a lot of good ideas out there, and that they will gradually, over time, get their scale, and you'll see those ideas pulled into business. And I think this is, in many respects, the digital asset space is still a very young industry, and a lot of people are feeling their way about what the right approach there is to this new technology. Do you invest in the end asset, like a crypto asset? Do you invest in the technology that is facilitating the decentralized finance world? Where is it that you want to play as an individual? Where is it that when we're thinking about the assets that we are putting in portfolios for our clients, what is it that we want to bring in to that? And I think at the moment, we're probably more comfortable with the technology than perhaps bringing in the end assets. But I think this evolution, it's not going away. Nobody's going to put this genie back into the bottle. So therefore, I think we just, all of us in the more traditional asset management space like me, it's really incumbent on us to get familiar and understand this ecosystem, this incredibly vibrant ecosystem that's going on under the surface.
Great. On that note, I think we're at time. Thank you so much for spending time with us this morning. And thanks to the audience for being attentive and engaged. Thank you.